Hello, everybody. Good afternoon. How are you doing? I hope everybody can hear me well. There, that should be better now. Okay, great. So we're going to get started on this webinar. And today we're going to cover a very interesting topic. It's one that maybe some of you are familiar with it, others are not. And I'm going to look at it right now on another computer so I can follow along as I'm moving forward. Okay. And essentially, what was the name of this webinar that I've given it? It's called Covered Calls and Naked Puts. So some people said, hey, that sounds really sexy. Well, maybe it does, but we're talking about financial instruments, which can be sexy if you're making money, and obviously if you're not, that's a little bit of a problem. So let's get into this topic right now, and let's see how it goes. If you got any questions, please, on the right-hand side in the top, you'll see a little arrow. If you click on that, it'll open up and there's a place you can enter questions, okay? And I'll be able to see any questions that anybody may have. And I'm doing this intentionally because this could get a little bit complicated. I hope it doesn't, but we'll take it all one step at a time, okay? So we first must begin with what's called a disclaimer, okay? And I have to do that just simply because, well, legal reasons, all right? So, Robert Bull, me, I'm not an investment advisor, I'm not an attorney, I'm not a CPA or an accountant or a financial advisor, okay? You agree that you bear responsibilities for your investment, financial, and tax decisions. You agree that me, Robert Bull, is not and will not be liable for any investment, financial, or tax decision that you make based upon the materials that I will be presenting. All information published various publications that I believe to be accurate and reliable. However, there are no claims or representations as to the accuracy and completeness or truth of any material contained in the following presentation. Please consult your own attorney, tax advisor, accountant, stockbroker, whatever you plan to do. Now, stocks and options tradings have large potential rewards, but they also have large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the stock or options market. If you have an account with any broker, you want to get into options, they're going to ask you the different questions about, the risk factor you're willing to take, okay? So please do not trade with money that you cannot afford to lose, because there's no guarantee in life. Well, there are two guarantees in death, okay? But that aside, and what we're talking about today, it's neither an offer to buy or sell or a recommendation of a specific stock or option. I stocks I'll be talking about, I'm not recommending them. These are just examples. I looked up on Monday. I haven't seen how they've done through to today. It doesn't really matter because that's not the objective of this presentation. Okay, so let's move forward. Okay, so as you know, I'm Robert Bull. Here I am. I'm from Venezuela, and I consider myself an international executive. Those of you who've been here before, you've already seen this, but those who haven't, welcome. I worked in Procter & Gamble. I also worked in Warner Lambert in the Adams divisions, and I worked a very long time with R.J. Reynolds Tobacco Company. Hey, the Rotary Club of Miami. Yep, I'm a Rotarian. I'm a member of the Rotary Club of Miami. And that's my team, my home team. And over here, you see University of Miami, Miami-Dade. I studied in both. I got my MBA and my BBA in University of Miami, and today I teach in both. Isn't that cool? Okay, so let's move down to where we're right now. We're going to catch up. Okay, so black swan, that's what we're talking about right now. And what's the plan for the future? How we're going to be able to transition back to business as usual? How do we plan ahead? What comes after this emergency? I was looking at what's going on today in Wuhan. Okay, Wuhan, they started with this. They're saying in December. It's not true. It probably started October, November. Okay, but still, they locked their city down in January, and here we are at the end of April, and they supposedly have opened up, but not really. A lot of the small businesses have not been able to open. The restaurants, you can only go to the door of the restaurant. You either place an order online or you pick it up. Movies, attractions, all these kind of things are shut tight, okay? So small, medium enterprises are a bit of a problem. And as you've probably seen, the Chinese GDP was down. Obviously, ours GDP was down because I think we've had a greater impact than China. Now, when we look at the United States, the unemployment probably will be at least 15%. I think it's probably going to be over 25. And the GDP based on Goldman Sachs is going to be down 34%. So we're really looking at an issue. Now, the reason why this is called a black swan, for those of you who don't remember, all swans were white. Is what they thought. The swans in England, the swans in Europe, anywhere in Russia, whatever. And when Mr. Cook, Captain Cook, not Pirate Cook, Captain Cook, went over to Australia, the British explorers, their surprise was Australian swans were black. How's that possible? There's not a black swan. Well, guess what? That was a surprise. So a black swan from a financial perspective is exactly that. It's a surprise that comes out of nowhere. Nobody could have predicted it. So that's what we have right now. But we have coming up after this, we now have the coronavirus crisis. What about the economic crisis? So that's a bit of a problem. So I decided to look at different stocks to try and help understand what is a covered call and what is a naked put. And let's just say for the fun of it, we're not on Zoom right now, we're in GoToMeeting. Later on today, I'll be in a Zoom meeting, and I'm not recommending one or the other, don't think I'm saying that. But let's just say for the fun of it that you decided to buy 100 shares of Zoom in mid-March. The price was $110. Okay, that's not too bad. Monday's price was $166. Wow, so you've made $56 a share. If you have 100 shares, you have an unrealized profit of $5,600. Now, these are terms that you may not be familiar with. Unrealized profits means that you haven't sold it. You've bought the 100 shares. The value of the shares has gone up, but you haven't sold it. You haven't exercised your right to get rid of those shares. So consequently, there's no tax impact or anything. It's what you could call a paper profit, unrealized profit, okay? Now, those people who bought it in March are very happy. Those people who bought it last year are even happier, right? I mean, come on now. Everybody's talking about Zoom meetings all over the place. So what could have happened? Let's just say you just came in mid-March. You heard everybody's doing this. You saw that. You bought it, okay? Cool. So let's have a look at what Zoom, and this is just a page. You can get it from any kind of brokerage you can imagine. It's not a problem. And this is Monday's, a print from Monday, okay? I needed to do that just so that I could, take a copy of it, and we're going back a little bit in time, okay? We're going back to Monday. So what do we see? Well, up there, I hope it circled the $166.28. Hey, that's really good, okay? That's really gone up. And over on this side where I hope my cursor is visible, it should be, this is the stock, the chart of the stock. Come on, let's go. Tell me this thing froze on me and I'll really have a fit. Did it freeze? Don't freeze. Well, it totally froze up. What am I going to do? Hello, guys. Hang on there. Oh, I went too far. It clicked too much. Let's go back. Okay, let's see if it'll go now. There. Okay, that's what I wanted it to do. Okay, so I hope you saw that little circle over there on the right-hand side. This is a stock chart. You can look where it was in February. Can you imagine if you bought this thing in February? It was in the 70s. If you go back even further, my gosh, it was much lower, okay? So this thing has gone all the way from down there, and here it's at the very nice top. It's done very, very well. It's up at $166, okay? And you own this thing. Okay, great. There's only one little problem. I don't want to call it a big problem. It's a little problem. There's no dividend. So basically, you're making unrealized profits, but you have no money coming in until the day you decide to sell it. But what if you don't know what to do? I don't want to sell it. I don't have a dividend. What can I do? Okay. Well, here's where you can do something. Okay. And here are the different choices you have. Okay. You have many choices. One, you can say, I'm going to close out the position. I'm going to sell it I bought it at 110, it's at 166. I'll make my $56 times 100. It's $5,600 profit. Good, I'll take it to the bank. Or I could say, you know what? I think this thing's going to go to whatever number. Okay, I think it's going to go up. I'm going to keep it. There's a third option you can do. You can rent out your shares. And what do we mean by rent? That's a term to use. It's really not rent. It's a way of getting some revenue from these shares, even though they don't pay dividends. It's called a covered call. You can sell a call. Now, for those of you who were not in my session before in calls and puts, let me tell you what a call is. A call, when I sell a call, it's an option. An option is a derivative. It's based on Zoom. One call equals 100 shares. And you notice here I said we had 100 shares. So if I sell one call, I'm basically giving you, if you buy it, the right to buy this call at a predetermined price. We'll make an agreement. You know, we'll look at the market and I'll say, I'll sell this call at X price. It's not 166. I'll sell it higher. And you'll say, look, I'd be interested in buying that in the future at that price. And I'll pay you so much. And I'll say, okay, fine, give me the money. Now, when I sell a call, I have the obligation. See, it says selling means that you have an obligation. I have the obligation to give you those shares when you want them at that price. It has to be within the period of time that the option is valid for, because options have a period of time from 30 days till basically 2 years in some cases, okay? But let's just say over a period of a couple of months, okay? In that period of time, I sold you the right to buy my 100 shares. So I have an obligation to sell it to you at that price. During that period of time, anytime you can say, give me the shares for that price. And I have no choice. I got to give them to you. Okay. So that's when we call, and the reason it's called a covered call, this is very important. I own the 100 shares. Never, ever, ever sell naked calls. Naked means I don't own anything. I'm just going to give you the right to buy something, but I don't have anything. I mean, you know, can you imagine? My risk is unlimited, and we went over this the other day. Okay, so right now I'm showing you an abridged version of what's called an option chain. It's an abbreviated version of it. And the reason I show that, because in any stockbroker, you can go and you can find out what the option chain is. And when I say option chain, if you'll notice over here, the word, it says, first of all, it says Zoom, and it says the date I just chose, June 19th, okay? So between today and June 19th, that's the length of this call. June 20th, if you bought the calls and you did not exercise your right to buy it, guess what? The calls are worthless. I keep my premium, okay? I keep the money that it was there for, okay? So you have calls on one side, you see the word calls, and over here, you see the word puts. So whenever you have an option chain, they show both of them, both the call and the put, all right? And then this line over here, and I'm gonna bring this down, okay, it's option chain, as it says there. It shows calls and puts. And the line in between that I put there, it's a blue, well, I know it shows a blue there, but this line is what they call at the money. What, at the money? It's basically at the basic price that the share is at. If you look at the pricing's on this line. It says here 165 and below it says 170. So basically that's at the money, 166, that's close enough. If you want to buy a call up here in yellow, that's called in the money. Why? Because you can buy a 165, but the thing's selling for 166. It gives you the right to buy it at 165, but it's at 166. Would I sell an at the money call or an in the money call? Maybe. Be crazy, okay? Because I'm basically selling you, hey, you can get this for nothing. So what we'll try and do, we're going to say, well, look, I'm going to sell a higher price call out of the money. And I just chose this one because I just wanted to have a redo. You know, when you look at these chains, the chains will have a whole multiple of prices on the way down and on the way up, okay? These are the prices. So I just left it at this level because it's comfortable for this class, okay? So if you look here, you'll see that there's different strike prices. Strike is on what your agreement is to buy and sell. There's always a buy and sell, okay? Here it says $180, 175, 170, 165, 160, 155. Okay, so those are the prices. We can decide what we want to do. And we're talking about calls because we want money to come in. We want to sell it at a higher price. You'll see here the word bid and the word ask, which basically means when I sell, bid is a selling price and ask is what you're going to pay. Now, there is a difference between what I'm going to get and what you're going to pay. Who's going to keep that? Somebody called the market maker, the people who marry the two people together. They get what's called a spread, the difference between the bid and the ask. You can always negotiate in between, try and come in between, but in this case, we're not going to do that. We're going to be really simple, okay? So we see if we're going to sell it, we'll be able to sell it at a different price. So the date I decided to choose for the fun of this was June 19th. Why? Well, all options expire on stocks, expire on the third Friday of the month. So June 19th happens to be the third Friday of that month, so that'll expire. It's going to give me, if you see over here, 53 days from Monday, because I did this work on Monday, okay? 53 days from Monday till then, at which times the option will expire. It gives the buyer, you who bought my call, the right anytime in those 53 days to say, give me those 100 shares at the price we agreed, okay? I hope you understood that. If you didn't, please let me know. I'm going to go to the question box right now and have a look. There are no questions there, so God willing, everybody is following along. Okay, now, as I said, all the options, and in this case, we're only looking at the call side, okay? Next example, we'll look at the put side. So if I sell this, I'll get these prices. I could sell a 170 and get it $21. Hey, that's cool. Okay, and you notice there's a difference. Okay, so I could say, you know what, 2170, 21. I'll offer this up for, pick a number, 2110. That's the last price it was sold at. I'll do 2120. We'll see. Okay, depends how quickly you want to move. All right. So along there, we have to decide what we're going to do. For the case of this exercise, I decided to use $180. What does that mean? When I sell my call and you bought it, you have the right to buy it from me on June 19th or before at $180. Now remember what this chart looked like. This company has gone from, I don't remember the number, it's gone from a very low number, boom, up to 166. Maybe it's going to go to 200. Maybe you think it's going to go 300. I don't know. But between now and June, next 53 days, if you think it's going to do well, you'll buy it, if that's what you think. But I want to get some money coming in, so I'll sell it. Now, the moment I sell it, I have an obligation to sell it to you at 180 whenever you want it. Now, obviously, if it's on the market something at 170, you're not going to say, hey, give it to me at 180, because, you know, you'd be losing $10. That doesn't make any sense, okay? So what can I get for it? I can get $17.10. So you would pay me $17.10 per share. There's 100 shares in an option, right? But $17.10 for you to have the right to buy my 100 shares at $180. That's why I call it renting. Okay, it's really not renting. It's a promise. I'm making you a promise to sell it to you at a future date at a price. Okay, it's a promise. I could lose my shares. Well, let's see what happens. And let's go forward a little bit more. Okay, so essentially, you've got the following thing on a covered call. If you're selling a covered call, most of the time you do not want the share to hit 180. You may say 180 is too cheap. I'd rather go to 200 or 210. That's okay. The chain will probably go beyond that. I just, for simplicity's sake, left it at 3 above, 3 below the at the money ratio. You see there, the three in the money, and there's 3 3 out of the money and 3 in the money, and this is at the money. So I just did it for simplicity's sake. All right. Okay, so basically, if you're going to do this, theoretically, you really don't want to, you don't want the price to reach that. You just want to collect the money. And then next month or next time when it expires, this was June 19th. Okay, so June 20th, you say, you know what? Hey, this thing got to 175. Didn't hit 180. I still have the shares. Oh, okay. Now I'll sell the 205 or the 210. You can do this time after time if you want. Okay. Now, if it does hit 180 or above, the buyer has the right to exercise their option. Doesn't mean they will, but probably they will. Okay. Let's say it's at 190. They'll say, I'll buy it at 180. Why not? Okay. They paid you the right for it. Okay. And I said, if it does not hit that premium, that price, that strike price, the word is called strike price, you keep that premium. That $17.18, that's yours to keep. You sold it. You keep it. They bought it. They lost it. Okay. So you must be happy to receive the strike price if it's 180. You got to say, listen, if it gets 180, I'll let it go. Fine. I'll be happy. I bought it 110. It got to 180. I made $70 plus. Remember right here, this beautiful thing right here. Where did my cursor go? There it is. You were paid $17.18 for, you and me, if it was I sold it, was paid $17.18 to give you the right to buy it 180. I'm still got the $17.18. So let's have a look at this. How do you place this order on your stockbroker? And every company is going to be a little bit different, but let's go do this one moment at a time. And when I place an order online, I speak to myself. Why? It's so easy to make a mistake. So somehow if I'm speaking to myself, if I'm paying attention to myself, it helps an awful lot, okay? So let's see the first thing I'm going to do. The first thing I'm going to do, I'm going to enter the symbol, Zoom, ZM. I need to do that because I need to know that I'm really doing that, okay? I mean, that's what I want. The next thing I'm going to do, I'm going to hit the word, and I hope that showed up because I can't see because my screen doesn't work the way I'd like it to. But the next thing I should do is going to say, what do I want to do? I want to sell to open. Sell to open. Why is it opening? We're beginning this transaction. Later on, I may sell to close. Whatever, let's just say 3 weeks from now, I'm making good money. I'll say, you know what? Forget it. I'll get out. So in that case, won't sell. I will buy those because I can't do double sell. Okay. I'm selling to open. I'm opening this contract. That's what I'm doing. I'm opening this contract. There we go. So I'll tell myself on my computer, okay, I'm going to do Zoom. I'm going to sell to open because we're starting this contract and I'm selling it. Okay. And this is what I'm going to remind myself. It's one contract. One contract equals 100 shares. If I have 300 shares, I could do 3 contracts. If I have 400, 4. But if by mistake I put 2 and I only have 100 shares, I got a huge risk out there, okay? Huge risk, okay? So I put that in. I also put in the expiration date, June 19th. I'm happy. 53 days, that's okay. I think this will not hit there in 53 days. And if it does, I really don't care. I'll keep my premium. And the strike price I wanted is $180. That's the strike price I want. The other thing I want to do, I want to put it in there again, the word call. I'm selling a call. This is a covered call. I am not selling a put because if I sell a put, that'd be a heck of a problem. I'd have to buy the product at 180 and I'd have somebody put it to me right now. And then it's going to tell me the price, $17.18. Guess what? I'm going to get that money. That's how much is coming into my pocket. Times 100 is $1,718. Okay. So what you got to look at on the chart on the left-hand side as you look at the page. Okay. We're selling to open a contract. This is a contract. I have to understand if I'm selling a covered call, I must deliver the shares if the price hits 180. Now, do I physically have to deliver it? No, it's going to come straight out of my account, my brokerage account. When the other person, when you decide you want to exercise your right, because you have a right, when you say, hey, I want those shares, the moment you say, hey, I want those shares, your broker will tell my broker, and boom, out it comes. Okay? You have to say, are you happy with $1,718 rent for 53 days. Wow, I think it's cool. Well, you got to remember your original purchase price, in this case, was $110 a share, and you can now get $17.18 a share. Forget about the appreciation from 110 to 166. That $17.18 is 15.6% return on your investment in 53 days, forgetting the fact that it's appreciated. Now, is this a good deal? Well, I frankly think I'm not recommending this. Remember, you don't listen to my recommendations here. I chose that price because I only wanted 3 strike levels from the at the money. Okay, to me it's too close because it could go up. I have no idea what happened with Zoom. Did it go up? Did it go down? It doesn't matter. It's got 53 days. That can easily hit that in 53 days. Okay, so I would have done one a little bit more out of the money, maybe 220, just to pick a number. But if we did the 180, that'd be fine too. All right. So let's have a look at how this looks on the risk graph. And I call this a risk graph because it tells you really what could happen, okay, on the Zoom covered call, right? So the first thing we're going to say is, okay, the current price when I bought it was, actually, the current price is today. I bought it at 110, supposedly, right? By the way, I didn't do this at that time. I just looked for something. So what I ended up doing, there's a strike price. Okay, so right now, today, this share is selling for $166. The fact I bought it 110 is meaningless right now. I mean, it's nice, but you know, that's where it is today. The strike price that I am selling is this one right here, $180. So it's got to go up 14 bucks, okay, for me to do something. Now, the moment I sell this, what happens? Okay, I'm going to receive the premium of $17.18. Okay, so the other thing is I've limited my reward on the price of the stock. The stock, if it hits 180, I'm out. That's it. I'm done. I'm done. I have to give it to you. If it doesn't hit 180, I'm still going to keep the $17.18. That's cool. Okay. So this next chart, next line, excuse me, says, well, what happens if it goes past it? Well, my break even from a perspective of what am I going to get? I can get, if it hits 180, I'm going to get paid $197.18. How's that? It's the $17.50 and 18 cents that you see over here. Okay, the premium I got plus the strike price gives you my break even. I'm calling it break even. It's really my total revenue. Okay, I am not going to be able to continue making money on the way going up. This thing can go to 220, 230, 250, wherever it goes. I'm sorry. And 187, I'm out. That's it. Sorry, 190, 180, I'm out. But I'm going to have an equivalent of 187.19, 197.18, excuse me. Now, let me start all over again. If I have to deliver at 180, I keep the premium of $17 and change. So it's 180 plus the 17, that's 197, okay? Now, in this case, in my opinion, and I don't make any recommendations, to sell a 180 when it's at 166 is a little bit too close for comfort. I'd probably go a little higher, which means I'd get less premium, but it doesn't matter. Say I got, I don't know, $8. Well, that's not too bad. $8, and I put in 110, get 8, that's over 7% in a very short period of time, by the way, okay? So let's look at something from a different perspective, a naked put. All right, we could have done naked puts in this case, but let's just say right now, you believe, and I think most people believe, the oil sector is in trouble. Stock prices could continue to tumble. Today, Shell Oil dropped its dividend rate for the first time since World War II. Okay, they cut their dividend by about 60-odd%. ExxonMobil says they're going to hold their dividend. I have no idea who's going to do what. But let's just say for this example, I'm just using example, this is not a recommendation, okay? But let's just say for an example, you say, you know what, I want to look at the oil stocks. Why? Because I think it's going to go down, and maybe I can do a naked put. You also like the high dividend that some of these companies are paying, okay? And you know it may get cut because gasoline prices have collapsed. You've seen it. You go to the gasoline, it's less than $2 a gallon. You know why? And the other day in Texas, oil producers had to pay the people who own the storage facilities, they had to pay them money to offload the oil. I mean, it's just crazy. It was a fluke. Really oil was never really negative in price. But anyway, it was a problem, okay? So what could you do? One thing you could do is short the stock. Short the stock means, let's say I don't own the stock, but if I have an account with a broker and I have money in my account, I can short it, meaning I can sell something I do not own. The brokerage house will be very happy to lend you the money, or lend you the shares is the right word, okay? But if I short the company and then the price goes up, ooh, that's a lot of money, okay? I could lose a lot of money on that. So let's look at Exxon and let's say, you know what? I'd be willing to buy Exxon at a lower price, even if the dividend is cut in half. Because if I get a lower price, it's still going to give me a good return on my investment. Okay, this is not a recommendation. I want to be clear on that. This is just an example. So let's have a little look-see at what ExxonMobil looked like on Monday. I have no idea what it's like today. For this class, it doesn't really matter. So Monday, ExxonMobil was selling at $44.16. That was the price. Okay. ExxonMobil, look at that dividend. It's paying $3.48 a year on $44 is basically 8%, 7.96%. Well, what does your bank pay you to keep your money? Nothing, absolutely nothing to speak of, right? So you may say, you know what? I like the 8%. But what if the price gets cut in half? Well, and the dividend, let's start the other way. The dividend gets cut in half and the price gets cut in half. Well, instead of making 8 on the money I invested today, well, what will I make? We'll see. Okay. So the other thing we can look at is where's it been? Okay. Was being as high as 80. It was all the way down to 30. Okay. So we know where it can go and we know where it's been at 30. And it was down at 30 over here, right? So there could be a good chance that we'll see, it went back up. So that's really good, but we don't know. What if it goes back down? You don't know, okay? So we're going to use the example that I said earlier, that you're just saying, okay, I'm willing to run that risk. And this thing's not cooperating with me. I think I've got too much stuff in my computer. There it is. Okay, thank goodness. So this is ExxonMobil's program, and we're going to sell a put option. And this is a naked put. We don't own the company. When we sell a put option, we're basically selling you the right, you're going to pay me the right to put the share to me. You're going to force me to buy it. I'm selling you the right to sell me the shares. In other words, I'm obligated to buy it if something happens, okay? And what I'm going to do, I'm going to sell my as my ExxonMobil at a lower price. And if you look at the strike prices, there's $50. Well, if you think it's going to go up, that'd be a place to go. How much you're going to get for it? Well, you may get some money, okay? And I also looked at 81 days out, July 17, okay? And then over here is the out of the money, because we know it's right here. So if it's less, it means there's, We're expecting it to go down, all right? So we're going to buy that company. And we have to have in our brokerage accounts, we have to have enough funds between cash or equity or something and a margin account. Margin means I can borrow to purchase 100 shares at expiration or any time. Remember, I'm selling you the right to put it to me. So within that period of time, which is 81 days, if it hits a little, let's say it hits 35, you can say, hey, I want to sell this to you at 37 and I have no choice. I got to buy it. Okay. So I have to have enough money to buy it at 37.50 times 100 shares is $3,750 I have to have in my account. It's not a lot of money, but still it works. Okay. And as I said earlier, I chose an expiration date of July 17th. There again, third Friday of the month. All right. We're right now essentially in May. So it's May, June. We're talking 2.5 months from now. I think oil's going to go down. I really don't think anything. But if I was doing this decision, if I was selling this option, then when I sell something, I become the writer because basically I'm writing you the right to do this. Okay. So what's going to happen then? Well, here's the prices that you see. The 37.50 put, which gives you the right to force me to sell it to buy it, excuse me, at 37.50, you're going to say, I'm going to pay $2 to force you to buy it. Now, why would you do that? I'll tell you why. If you owned ExxonMobil and it's at 44, and you're saying, wow, what if it goes down to 30? I don't feel comfortable with that. I can deal with 35. If it goes to 35, I'm okay. But guess what? How do I manage that? Well, I can, remember, you're going to sell, I can buy a put, which gives you the right to put it to me because I'm going to sell it to you, the right to sell it to me at 37.50. But you know what? You paying me $2 for that. So in effect, you're going to be selling to me at 35.50. All right. So it's a little bit complicated there, but let's just look at it from a perspective of my position. I'm willing to buy the stock at 37.50. It's now at 40 something. I don't remember the price anymore. I have to go up on the charts, but it's at 46. I think that was the number. Whatever the number is, 40 something. I'm willing to buy it. I'm going to look here, right here, actually. It's somewhere between these prices, okay? Because that number over here this is the at the money area right there. These are strike prices, okay? And we're on the put side. So I'm saying, you know what? I'm willing to buy this company at 37.50. So how do I place that order? Well, here again, number one thing I'm going to do, I'm going to input the word Exxon or the symbol Exxon. Why? I want to be sure I'm trading the right stock. Okay. There are other products like X. I think Xerox was X. I don't remember anymore, but you can always make a mistake. So, and I said before, I speak to myself. I'm going to sell to open. Okay. Because I'm selling it. All sellers are called a writer. I'm selling to open. We're starting this contract. If it goes against me anytime, I can buy it back and get rid of it. I'll buy to close. I'll limit my loss, but we'll figure that out later, okay? And I want to buy 100 shares, okay? That's my goal, 100 shares. I want to buy 100 shares at $37.50. So I put in there, I want to buy one contract. So now I know my risk. What's my risk? It's $3,700. That's my risk. Not the total risk. That's the money I have to buy the shares. Okay, the company could go down to $30, and my risk would be, it's not a total risk because I don't think ExxonMobil is going to go broke tomorrow. The other thing, what am I doing? I am selling a put. This is a naked put. I don't own it. I want to buy it. I want to buy it at a lower price. So by selling the put, I circle the word put. There's no doubt in my mind. I will have this put to me if it goes to 37.50 or less. But if it doesn't, I'm going to be able to keep the $200 I'm getting, which is $2 a share for 100 shares. Okay, so let's look on the left-hand side in that blue box. We're selling the put to open the contract. This is a contract. I or you, it depends who sells the put, must buy the share if the strike price hits 37.50 during this period of time. It goes down, okay? Let's just say it goes down in 30 days at 37.50. Since I sold it, I have the obligation. But if you own the shares, you may say, nah, I'm not going to force this guy. I'm going to keep it. I got time. What if it comes back? Or what if you think, oh no, this is really going south. Give me the money now. So you as the buyer of that put, you have the right to put it to me anytime in that period of time, which is 81 days. Anytime in those 81 days, you can put it to me. But it's up your choice when you want to force me to buy it at 37.50. If the stock's trading at 39, you obviously wouldn't sell at 37.50. If it's at 36, you may say, well, I don't know. What if it comes back? I don't want to, I got these shares from my grandmother, whatever reason. I don't know. You have the right, not the obligation. Okay? Now, the question is, are you, and I'm saying me, am I happy to earn 200 bucks in 81 days on this amount of money? Am I happy with it? Well, let's have a look. Remember, during this period of time, since I do not own the shares, okay, the broker's going to hold $3,750 because that's $100 shares times 37.50. They're going to hold it as a guarantee that I will purchase the stock if it's exercised. Those 100 shares, at the end of the period of time, boom, they're put to me. I have to buy. I have no choice. They're going to come into my account. So that $3,700, $750 has to be in my account somewhere, either in cash or in a margin agreement, which means there will lend me the money to buy the stock. Okay. So if the stock is exercised, and the only person who can exercise that right is the guy who bought the option. He exercised the right. I cannot exercise anything. I have an obligation to buy. Okay. So I'll make 200 bucks and I'll have $3,700 put away, which is a return of 5.3%, $200 over the money that's holding there. Makes 5.3% in 81 days. Wow. What does the bank pay you again? 0 point nothing? 5.3%, 81 days. Let's just round it to 90, multiply it by 4 to give you an annualized rate. It's 20% a year, but still I'm making 5% on $3,000. That's a very nice return on your money, I think. So I'm not saying for you to do this. I don't know what's going to happen to ExxonMobil. Maybe it makes more sense just to buy the stock and watch it go up. I don't know. What if it goes down? So this is just a way that you don't have to own the stock. What is your investment? Think about it. You have $3,700 that are in hold, but you got paid $200. So you really have $3,550 that are out there. Okay. So let's have a look. So here we are. Okay. And the first number up there should be where the stock is now. And we're afraid it's going to come down. Okay. And we're not afraid. We want it to come down. Okay. And there, right there, you see the strike price, $37.50. I'm willing to buy it at that price. And that's the premium, $2 a share that I'm going to get. So I have limited reward. I'm going to get $2. That's my reward. I do have something that we're going to call my break even. If the share goes down to $35.50, I break even. Why? Because I'm forced to buy it at $37.50. I'm forced to. I have no choice. But I got paid $2 to do it. So my break even is $35.50. So as long as it doesn't hit $35.50, I'm okay. Now, what happens if ExxonMobil goes broke? Well, we're saying unlimited is not unlimited because zero's the end, okay? But below $35.50, I lose money. I'll have no choice other than to buy it at $37.50. And whatever price, if it's below 35.50, it's a losing trade. Then I have a decision as to what I'm going to do. Okay. So this is a naked put. Naked because I don't own it. Okay. But I'm willing to sell you the right to sell it to me. Okay. Because I'm willing to sell a put, which gives you the right to put it to me. And I get $2 a share, which is, we said earlier, 5% over 81 days, which if you annualize is 20% a year. That's not too bad. I mean, $200, you say $200 is nothing, but wait, $200 on 3,750 bucks? That's not too bad, okay? That's not too bad at all. You want to extend it, you say, oh, I got more money, I'll do 1,000 shares. That'd be 10. Okay, instead of getting 200, you get 2,000. Does that sound more interesting? Whatever you choose. I'm not encouraging you to do anything, okay? I just want you to understand the concept of a covered call and a naked put. These are two basic things that you do not need a lot of experience to do. And I would say that you don't need a lot of experience because your brokers will not demand an awful lot. These are simple strategies. Do they always work? You know, I've sold covered calls. I liked it when I made money. And sometimes when it was taken away from me, I said, oh my God, I should have never done that because, wow, it went way up and I sold it cheap. You know, that's the risks. You never know. Okay. So you can decide what you want to do. Naked puts, I've done them all the time. But I do them in things like this that are fairly, low priced. Right now, the way the volatility of the market is, it's really scary because I don't know what the bottom or the top is. The market's gone up from where it was a couple of weeks ago. Is it going to continue going up? Nobody knows. What I can tell you, we're going to come out of the coronavirus crisis, and then we're going to have a major economic crisis. And that's just a terrible thing, but that's what unfortunately is going to happen. So before we conclude, I have to say the disclaimer again because people joined after we started, and just very quickly. Robert Bull is not an investment advisor. I'm not an attorney, CPA, accountant, etc. The important, you can read it yourself, but the important thing is the bottom paragraph. Stocks and options trading has a large potential rewards, but they also have large potential risks. You must be aware of the risk and willing to accept them in order to invest in a stock or an options contract or market. Please do not trade with money that you cannot afford to lose or part of it or all of it. This is not an offer to buy or sell. It's not a recommendation. Yes, we spoke about Zoom. We spoke about Exxon. I'm not recommending any of them, okay? So please do not think I am, okay? That would be a total mischaracterization of what I am trying to do, okay? So I want to thank you for attending this webinar. The next webinar I'll be presenting will be on Tuesday in a couple days from now, May 5th. My God, there we are, Cinco de Mayo. Okay, oh, we'll have a Cinco de Mayo. Okay, the topic's going to be something that if you're, I don't know, if you're over 40, you'd really should listen to this. Actually, you should listen to this no matter what age you're at. But anyway, we're talking about Social Security and understanding the benefits. Okay, and there's a whole series of benefits that you can use, etc. We'll be getting into that. And in regards to today's webinar, if you have any questions, you can email me at rbull.miamirotary@gmail.com. You can look at my Facebook page. I'm under Robert, or you can look at, Robert Bull, or you can look at www.fespa.com/Fespa Financial, but the first Fespa is a small f, financial is a big F. And then I have a YouTube channel. If you look at it in the FESPA, you won't find it, or maybe it will, but it'll be taught. There are a lot of other FESPAs out there. But there's a short URL called shorturl.at/b capital DGMT. So folks, we're ready to go. I just hope my system will let me exit. It's gone a little bit slow. I think my PowerPoints are just too big for this because we've been doing a whole series of these meetings and it's just not closing out on me. So feel free to sign off. I'll figure out how I get myself out of here. It's just not responding to me right now. I'm very sorry for that. Please feel free to go. Don't worry. Let me see who's on there. Oh, a bunch of people I know. Thank you. People I don't know as well. Thank you very much for attending. And if you have any questions, feel free to contact me. This thing is just not responding to me, folks. Nothing is responding. I can't close it down. I see John Carroll and David McManus. You guys are still there. Thank you so much. I guess this Surface Pro can't deal with this. Wow. This thing continues to record, and there's nothing I can do.